Most traders believe their biggest problem is strategy. They believe somewhere out there is a better entry, a better indicator, a better system that will finally remove the pain from trading. So they keep searching. One more video, one more setup, one more adjustment to the rules. And for a short time it feels productive. It feels like progress. But slowly, something begins to happen beneath the surface. The charts start to look the same. The strategies start to sound the same, and the losses still appear. What the trader does not realize at this stage is that the real struggle has very little to do with the market. It has to do with what happens inside the body when money is placed at risk. Financial risk triggers something ancient in the nervous system. The brain does not interpret a losing trade as a simple financial event. It interprets it as a threat. Heart rate increases. Attention narrows. The mind begins searching for relief. The body wants the discomfort to stop as quickly as possible. And in trading, the fastest way to remove discomfort is action. This is why many traders click the button again immediately after a loss. Not because the next trade is clear. Not because the market suddenly changed. The action is simply an attempt to regulate the emotion created by the previous trade. In that moment, trading stops being a professional activity. It becomes emotional regulation. The difficult truth is that the market does not reward emotional regulation through action. It rewards emotional stability through restraint. A developing trader rarely understands this. He believes improvement will come from learning more patterns. But the real transition begins when he notices something uncomfortable about himself. The mistake was rarely in the chart. The mistake was in the moment he could no longer sit still. Stillness sounds simple. In practice, it is one of the hardest skills a trader can build. When nothing is happening, the mind begins to create reasons to act. A small movement looks important. A minor fluctuation begins to feel like opportunity. The trader tells himself he is being proactive. In reality, he is trying to escape boredom. Boredom in trading is not a problem. It is a signal that risk is currently unnecessary. Professional traders learn to respect this signal. They understand that activity and progress are not the same thing. Many days in the market offer no advantage. Acting during those days slowly drains both capital and mental clarity. The amateur experiences stillness as wasted time. The professional experiences stillness as protection. This difference in interpretation quietly separates the two identities. At first, the trader measures himself by results. A winning day feels like proof of intelligence. A losing day feels like evidence of failure. The emotional swings become exhausting because the identity of the trader rises and falls with each outcome. Over time, something important begins to change. The trader starts to see patterns not only in the market, but inside himself. He notices how urgency appears after losses. He notices how confidence becomes inflated after wins. He notices how the desire to recover money quickly appears strongest when the mind is least clear. This awareness is uncomfortable because it removes the illusion that the problem is external. But it also creates the first real form of control. A trader who cannot control the market can still learn to control exposure. He can reduce position size. He can slow the frequency of trades. He can choose to step away when emotional pressure rises. These actions may appear small, but they begin to stabilize the nervous system. And stability is the foundation of professional decision-making. Small position size is not a limitation. It is a training environment. When risk is small, the body stays calm enough to observe clearly. When the body is calm, the trader can see the difference between a genuine opportunity and the urge to act. Most people try to grow their accounts before they grow their stability. This reverses the correct order. A trader who cannot remain calm with small risk will lose control completely with large risk. The nervous system simply cannot handle it. So the early stage of development becomes less about finding trades and more about learning to remain regulated while uncertainty is present. This phase feels slow. Sometimes it feels like nothing is happening. Weeks may pass with minimal progress, but something important is quietly forming beneath the surface. The trader is learning that survival is the real objective. Profit eventually comes to traders who survive long enough to understand themselves. But survival requires restraint. It requires accepting that many opportunities are not necessary to take. It requires the humility to stay small while clarity is still developing. This is the moment when the identity of the trader begins to shift. The emotional trader looks at the market and asks how much money can be made today. The regulated trader looks at the same market and asks a different question. Is there any reason to risk capital right now? That small change in perspective marks the beginning of professionalism. The trader is no longer chasing movement. He is protecting clarity. And clarity grows only in the presence of patience. 11 Lab DMYRGZ-F-NY-1PAM5HTTPS://B440-171-224-178-200-NGROK-free.app. TS_9.2. There is a moment many traders experience that they rarely speak about. It is not the excitement of a winning trade. It is not the panic of a sudden loss. It is the quiet period in between, when the charts are open and nothing feels clear. The candles move, but the meaning is uncertain. The mind begins to search for something to do. At this point, the inexperienced trader feels pressure. He believes he should be participating. After all, the market is open. Prices are moving. Other traders are active. Sitting still begins to feel like falling behind. But what is actually happening inside the body is more subtle. The brain dislikes uncertainty. When there is no clear outcome, it tries to create certainty through action. A trade becomes a way to resolve tension. The position gives the mind a temporary sense of direction. Something is finally happening. For a few minutes, the discomfort disappears. Then the market moves. Sometimes it moves in the trader's favor and the mind feels relief. Sometimes it moves against the position and the nervous system tightens again. Now the emotional cycle begins. The trader watches every tick. The mind starts calculating how much money is being gained or lost. Attention shrinks until the entire world feels contained inside a small moving number. This is the psychological trap that captures most developing traders. They believe they are studying the market, but in reality, they are monitoring their own emotional state. Every fluctuation begins to feel personal. The body reacts as if survival is connected to the outcome of the trade. Stress hormones increase. Breathing becomes shallow. Decision-making becomes reactive. Under these conditions, even a well-designed strategy begins to break down. This is why discipline is not primarily about rules. It is about nervous system regulation. A rule only works when the mind is calm enough to follow it. When the emotional system becomes activated, the brain searches for immediate relief. The rule that once seemed logical now feels restrictive. The trader tells himself the situation is different this time. He adjusts the stop. He adds to the position. He exits too early or holds too long. Each of these actions feels justified in the moment. Later, when the emotional wave passes, the trader looks back at the chart and sees the mistake clearly. This creates frustration because the knowledge was always present. The problem was not understanding. The problem was regulation. Professional trading begins when a person stops asking how to predict the market and begins asking how to remain stable while uncertainty unfolds. Stability changes the entire relationship with risk. When the nervous system is calm, the trader can observe without urgency. A trade can be evaluated objectively. If conditions are unclear, there is no pressure to force a decision. Waiting becomes natural rather than painful. This is why experienced traders often appear inactive for long periods of time. It is not hesitation, it is selectivity. They have learned through experience that clarity appears only occasionally. Most of the time, the market is simply moving without offering a meaningful advantage. Participating during those periods slowly erodes both capital and emotional balance. So the professional approach becomes simple. Risk only when the conditions are obvious enough that the mind remains calm after entering. If entering a trade immediately creates anxiety, the position is already too large or the reasoning is not strong enough. Either way, the correct response is reduction, not justification. Many traders try to control their emotions through willpower. They tell themselves to be stronger, more disciplined, more confident. But emotional control rarely comes from force. It comes from structure. Structure means smaller positions, fewer trades, clear limits on risk, time away from the screen when fatigue appears. These decisions protect the nervous system from becoming overwhelmed. Once stability becomes consistent, something interesting begins to happen. The trader starts noticing that opportunities were always present. They were simply hidden behind emotional noise. When the mind becomes quiet, the market becomes easier to read. Not because the trader suddenly gained a special ability, but because perception improves when urgency disappears. At this stage, the goal of trading changes again. The emotional trader tries to maximize profit. The developing professional tries to minimize mistakes. By focusing on reducing unnecessary trades, reducing emotional exposure, and protecting capital, the trader slowly builds a stable base. Profits begin to appear as a byproduct rather than the primary objective. This is a subtle but powerful shift. Instead of chasing the market, the trader allows the market to come to him. Days of inactivity no longer feel like failure. They feel like discipline. The account becomes something to protect rather than something to constantly test. Over time, this mindset transforms the experience of trading entirely. The charts stop feeling like a battlefield. They begin to feel like information. And the trader begins to understand something that cannot be learned from strategy alone. The real edge in trading is not speed or prediction. The real edge is emotional neutrality in the presence of risk. 11 Lab DMYRGZQFNY3 JI11Y1PAM5HTTPS:/B44O-17-224-178-200.ngrok-free.app. TS_9.3. At some point, every serious trader reaches a phase that feels strangely empty. The early excitement is gone. The constant experimenting with new strategies begins to slow down. The trader has already seen enough charts to know that most movements repeat familiar patterns. Yet the consistent results he once imagined still seem just out of reach. This period often feels like stagnation. The trader sits in front of the screen and wonders if progress has stopped. There are fewer impulsive trades than before, but profits are still small. Weeks may pass where the account barely changes. Some days produce small gains. Other days produce small losses. Nothing dramatic happens. Many people leave trading during this stage because the mind interprets the lack of excitement as lack of growth. But what is actually happening is the formation of stability. Earlier in the journey, trading was driven by emotional impulses. The trader reacted quickly to every movement because uncertainty felt uncomfortable. Now something different is happening. The nervous system is slowly adapting to the presence of financial risk. Losses no longer create the same shock they once did. The body does not surge with the same level of urgency. The trader can observe a losing position and close it without the same internal argument that once lasted for hours. This change often feels subtle, almost invisible. Yet it represents one of the most important transitions in trading development. The trader is no longer fighting the market. He is learning to work within uncertainty. During this stage, patience begins to feel natural rather than forced. Sitting without a position no longer feels like wasted time. It feels like observation. The trader watches price movements calmly and allows information to accumulate before making a decision. Sometimes the market moves strongly without him. Earlier in his journey, this would have created frustration. The mind would immediately begin imagining the money that could have been made. That reaction often pushed him into the next trade too quickly. Now the reaction is different. He notices the missed opportunity, acknowledges it, and continues observing. There is no urgent need to chase the move because the trader understands that markets never run out of movement. Opportunities are not rare events that must be captured immediately. They return again and again for those who remain patient. This understanding removes a great deal of pressure from the trading process. Instead of trying to capture every movement, the trader focuses on preserving clarity. Missing a trade becomes far less damaging than entering one while emotionally unsettled. Gradually, the relationship with money begins to change as well. In the beginning, each dollar carried emotional weight. Gains felt like validation. Losses felt personal. The account balance seemed connected to self-worth. But as discipline develops, the money begins to look different. It becomes a tool rather than a score. Its purpose is to allow participation in the market while protecting the trader from emotional instability. This is why experienced traders often repeat a simple principle: protect the capital and the capital will eventually grow. Protection does not mean fear. It means respect for uncertainty. Every trade contains an unknown outcome. Accepting this fact allows the mind to remain balanced regardless of what happens next. When a loss occurs, the trader does not experience it as a personal defeat. It is simply information. The trade idea did not work under current conditions. The capital is reduced slightly, but the clarity of the trader remains intact. Maintaining clarity is more valuable than recovering money quickly. Attempts to recover losses usually come from emotional discomfort rather than logical opportunity. When the mind tries to erase a loss immediately, it begins forcing trades that would normally be ignored. Professionals recognize this pattern early and interrupt it. They reduce risk. They step away from the screen. Sometimes they stop trading for the day entirely. These actions may appear overly cautious, but they serve an important psychological purpose. They prevent emotional escalation. Once emotional escalation begins, the trader gradually loses the ability to evaluate risk objectively. A single loss can quickly turn into several if the nervous system becomes overloaded. By stopping early, the professional protects both capital and mental stability. Over time, this behavior creates a quiet confidence. The trader no longer needs constant wins to feel secure. Confidence comes from knowing that mistakes will remain small and controlled. Even during difficult market conditions, the account remains stable because the trader refuses to engage in emotional decision-making. This form of confidence is very different from the excitement that many beginners mistake for skill. Excitement is fragile. It disappears quickly when losses appear. Calm confidence grows slowly through repeated experiences of restraint. Each time the trader respects his risk limits, the nervous system learns that stability is possible even when money is involved. Eventually, trading becomes less dramatic than most people expect. There are no intense emotional swings. There are long periods of observation, occasional decisions, and steady protection of capital. Progress feels quiet rather than explosive. But quiet progress has something powerful behind it. It can last. 11 Lab DMYRGZ QFNY 3JI11Y1PAM5HTTPS://B44O-171-224-178-200.NGROK-free.app TS_9.4. Many traders imagine that the final stage of development feels like constant certainty. They expect that one day the market will simply make sense and every decision will become obvious. But the reality is different. Uncertainty never disappears. Even experienced professionals open a chart and see multiple possibilities. Price can rise, price can fall. News can appear unexpectedly. Liquidity can vanish. No amount of experience removes the basic uncertainty that defines markets. What changes is the trader. Earlier in the journey, uncertainty created tension. The mind demanded answers immediately. The trader searched for confirmation from indicators, opinions, or predictions. Every trade carried emotional pressure because the outcome felt important to personal identity. But after enough time spent observing both the market and the mind, something begins to settle. The trader stops demanding certainty. He accepts that every position is simply a probability. Some will work, some will fail. The purpose of discipline is not to eliminate losses, but to keep them small enough that they never threaten survival. Survival becomes the central philosophy. As long as capital is protected, the trader remains in the game. And remaining in the game is what allows opportunity to eventually appear. Markets move through cycles of activity and silence. Some months offer very little. Other periods produce clear movements that unfold slowly over time. The trader who has preserved both capital and emotional stability is able to participate when those movements arrive. This is why position size remains small, even for skilled traders. Large positions excite the nervous system and disturb clarity. Small positions allow observation to continue even while a trade is active. When the mind is calm, the trader can simply watch the position develop. If the idea proves wrong, the exit is taken without resistance. If the idea begins to work, the position is allowed to continue without the urge to interfere. This patience is not dramatic. It is almost quiet to the point of appearing uneventful. Days pass where nothing needs to be done. The trader studies the market, reviews past trades, and maintains routines that support mental stability. Sleep becomes more important than late-night chart watching. Physical movement becomes part of daily structure. Time away from screens becomes necessary for maintaining perspective. These habits may seem unrelated to trading, yet they form the environment in which clear decisions are possible. A tired mind seeks stimulation. A stable mind waits. Over months and years, this way of operating slowly transforms the identity of the trader. The emotional reactions that once dominated every trading session begin to fade. The need to prove something to the market disappears. The trader is no longer trying to defeat the market. He is cooperating with it. When conditions are quiet, he remains quiet. When conditions become clear, he participates with controlled risk. Each decision follows the same simple principle. Protect clarity first. Profit comes later. Eventually, the results begin to reflect this stability. The account grows slowly at first. Then gradually, the consistency becomes visible. Losses remain small. Gains accumulate over time. Nothing spectacular happens on any single day, yet the overall direction becomes steady. This is the outcome that most traders imagine at the beginning but misunderstand completely. Consistency is not built from aggressive action. It is built from restraint repeated thousands of times. The trader who survives long enough to understand this truth often looks back at the early years with a certain calm perspective. The frustration, the doubt, the impatience, the long periods where progress seemed invisible. All of it was part of the training. The market never demanded perfection. It only demanded stability. It required a person who could remain balanced while money moved unpredictably. Someone who could wait without becoming restless and act without becoming emotional. That kind of trader is not created through excitement or motivation. He is created through patience. And patience grows each time a trader chooses discipline over impulse, clarity over urgency, and survival over the need to be right. 11 Lab DM YRGZ QFNY3 JI1Y1PAM5 HTTPS://B440-171-224-178-200.NGROK-free.app